All right, stocks went up for a seventh day in a row today, finishing slightly higher, about as slightly higher as you could possibly finish. But again, finished higher. So going into tomorrow's FOMC meeting, where the Fed is widely expected to cut rates, the question is going to be how much and how much are they going to cut rates by the end of the year and into next year. That's going to be the really important factor we're going to end up talking about in tomorrow's market outlook video. But today, not surprisingly, a very small range, very small, low volume, kind of a sideways, nothing day. Now, a lot of chatter about broadening. There's a lot of, in the past 2 days when the market really hasn't moved anywhere, there's been a large amount of broadening, a lot of breadth, a lot of new highs, a lot of stocks above the 50-day moving average, flirting with 400 today, or 80%. So a big breadth move, while the broader market, the S&P 500, is flat. So again, kind of showing that we might be tailing off on this current rally that started with essentially Nvidia and XLK, and obviously is not finishing that way. But we could get a boost, right? Tomorrow we could get a nice strong boost. Traditionally, it does give us a boost. So we'll talk about what we should expect to see, what our expectations are based off the current technical environment. We'll take advantage of that expected boost with our trade idea. We'll take a look at the sector rotation and talk about that broadening and how likely that is to persist, and whether or not we'll get a stronger move higher in XLK again, and that's going to be our trade idea for the day, and one of the big stocks in that space. We'll talk about how to trade that going into and coming out of tomorrow's FOMC meeting. So let's go ahead and get started. Today is Tuesday, September 17th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. And if you're watching us on our blog here, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at all the old trades we've done in previous videos, and we close out a couple today. We rolled one today. We did that there in the live video. We also we did our today's trade, our idea at the end of the video. We already put it on before the market closed. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Click this thumbs up icon, it opens up this tab, hit that like button there as well. That helps get our content out to all of our followers on those platforms when you do that, so thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we another new day to the upside, barely, but we did make it, right? It's more than a point. We made it 1, 2, 3, 4, 5, 6, 7 days in a row. The intermediate line back above the 90th percentile, so back at strong bullish levels. The near-term line is out of the reversal zone, but still in bullish territory, so not too bad there. The momentum line was oversold at the lows of the day today, but a little bit of a bounce up at the end. Brought the momentum line back out of oversold territory. So we were looking at a second straight intermediate confirmation signal. So we didn't get another good bullish signal. Ideally, it would have been good, assuming that tomorrow we're going to rally on the Fed announcement, which you would expect that we will. As I tweeted out, if you follow me on Twitter, I tweeted out, we typically do pretty well on the days the Fed cuts. If we get a 50 basis point cut, we typically do pretty well. We've gone up 4%, 5%. So assuming we get a good rally, even if we only get 25 tomorrow, it would have been nice to go into it with a bullish intermediate confirmation signal, like a buy, especially if the near-term line was a little bit lower. It's still in bullish territory, so if we bounce, we probably will just extend this near-term rally rather than start a new one. You always kind of like to start a new one because they can last 7 to 12 days. This one's already been going for 7 days, so only a few more days for its typical range left. If you look at the NASDAQ 100, excuse me, it is also relatively bullish. Again, not anywhere near new highs. Remember, the S&P 500 is actually at new all-time highs. The NASDAQ 100 is clearly not close to it. It's at 20,700 roughly, and we're still below 19,500. The intermediate line's not in the reversal zone. The near-term line has crossed down below it. So that's a bearish crossover. When remember the intermediate lines between the reversal zones, the crossovers of the near term line are either bullish or bearish. In this case, bearish because it's a breakdown, and it's also out of bullish territory. So a little bit more bearish than what we see on the S&P 500. The market sentiment's actually falling still in the lower half of the chart. But at least the intermediate line's above it. So that's a positive development. Obviously dark green shading and a green line there. Your Dow Jones has been really strongly bullish, has been getting new highs for the last few days. Another one here today, if we're down a little bit. Excuse me, sorry about that. The intermediate line is in the reversal zone above market sentiment. It is rising. The market sentiment line's rising. And now we do have a bullish intermediate confirmation signal. So the momentum line did dip into oversold territory. Again, it would be better if the near-term line, but at least we're only a few days into this near-term rally. So we can bounce off of that oversold momentum line and really start to move up tomorrow. And then finally, looking at your Russell 2000, you can see the intermediate line has crossed into bullish territory finally. It recently was bearish, right? We did have an intermediate decline on the Russell 2000, but now we're back to being bullish and a nice, we got the bear tag 2 days ago. We're obviously clearly above the high point of that tag, building on it. We're 3% above the moving average. Like I said, the intermediate line is crossed above market sentiment, which has been flat for a long time. But we're on the upward swing at least right now, and of course the near-term line at very strong bullish levels and almost a bullish intermediate confirmation signal. Again, it would be a weak one there because the intermediate line's not above 80 yet. But oversold momentum line suggests, as you can see with all these other lower levels, that we can bounce off of this tomorrow as well and maintain the current bullish intermediate posture. Let's take a look at the weekly chart. You'll see here that we have, again, a bullish candle, a couple transitions. We're still bullish. The question, and what would really be bullish, we've already got a higher high and obviously a higher close. We would love to close above that high point. The high point's 56.36. Right now we're at 56.31 on the Hakinyashi close, right? We're at 56.34 on the regular close. But the more we can rally in these last 3 days of the week, the more, and the more we close, if we can close above all these highs, that would be even ideal, especially if we can close above like 56.69 on the Hakinyashi close. That would be great. That's where the week's high is, 56.70 there. So we got to get the Hakinyashi close up to that level too, and then that would be the most bullish because that would be like, okay, we're breaking out, kind of like over here what we did when we kind of closed above all these highs and we really took off to the upside from that point. So that's kind of what you're hoping to get, at least what I'm hoping to get with this weekly candle, and obviously would end up being it's a relatively weak bullish candle now, but if we can get up a little bit higher, especially here next week, that would be a good move, a good strong start to this weekly run that we're on. Obviously, we have 3 green arrows all across the board for multiple days now, and doesn't look like we're going to get a red arrow anywhere. The MACD momentum is not the strongest, but at least it's pretty clearly above 0. So we're not any threat of any of these 4 charts getting a red arrow anytime soon in the next day or two. Again, barring a big drop, which is unlikely, with the FOMC meeting. The MACD, you're above the moving averages up here. We're above the value area. In fact, the 200-day, we can drop all the way. We could have a pullback on the S&P 500 and still not break into the value area. That's how bullish we are right now. So the MACD is up above its moving average and positive. The stochastics is back into its reversal zone, so very strong bullish levels there. You'll see strong bullish levels as well, kind of. The DMI isn't quite back to bullish levels yet. We need to get above 25, and we're not there. The Qs is worse, right? The Qs is the negative level. It's not below 20. At least SPY has the negative level below 20, and that's not the case here. So kind of bullish, but not really. But the RSI and the CCI finally have got, they ended up down. So, we were flirting with above 60 and above 100, and we ended up not getting that. Tomorrow, again, widely expected that we would rise up and get above those levels and ideally get above 150, and we'd feel really good about, this continuation of a good bullish run right now. If you look at the Ichimoku cloud, We are above the cloud. It's the pink shading, so that's good. And we're clearly going to be above it by the time it turns green. Strong rate of change. We don't even have a trend developed yet. So, I mean, if we're going to get a good trend where we end up with a mature level, we haven't even started it yet. So that's a good sign that we're as bullish as we are and we haven't even started a trend. The bandwidth, we're in the upper quartile still. We're not above the upper band. The bands are still inside the Keltner channel, but again, a nice little push tomorrow. We'll break above that, start this new bullish momentum move up to the upside, and we can, like I said, get started on a new run kind of like this, like we saw, right here where we really got going on a bullish move. We can do that again with this run that we have. All right. Let's take a look at today's move. You can see we got a new 4-week high point. We did not close above yesterday's high, so a little bit of weakness there, but it is a higher high and a higher low. We also did not close above last week's high point, right? We opened up above last week's high. We traded back down, so 2 days now we've been below last week's high point. So that's something to kind of keep an eye after. Again, at least getting a new on this little pop-up we had this morning, getting a new 4-week high point that brought this line back up to 100. So that's a very good sign for the S&P 500. As I mentioned, we did get a new high. The volume was relatively average. The trading range was below average. That's actually okay. We want the average range to drop below 1%. So, right now that would be below 5.6 points. And, that's way down here. So we still got some room for that to fall so we can really establish ourselves on this trend. And you can see the volume just really doesn't have a whole lot more room to fall because we've already had that on the last leg higher. It's rare to break through 52-week lows on the average, and we did in such a dramatic way here in the summertime. So unlikely we'll do that here. So at least we're already at low levels. The problem is, again, it probably means that we're not going to get a nice extended long intermediate run here because we're not coming down from a peak off of this low point like we were over here. If you take a look at the VIX, and this is, the obvious, it's not surprising that VVIX is up to 107. Either we get a big drop in the markets, which again is the unlikely scenario, and the VVIX rallies, or the VVIX is going to drop big tomorrow. So the VVIX is only up because of the FOMC meeting, still above 100. So we're still susceptible to a move, but we are at bullish levels and volatility below 90%. So again, leaning more, even the volatility market here is leaning towards the market being more bullish than not. The stock market being more bullish than not. You can see we're below these short-term moving averages. Even with a little bit of a rally today, we're still below these averages. And now we just have to get below the 200, which is just under 15, and we can establish a new trend again, an extended trend up to the upside. All right, so if you take a look at what's been trending, you can see over the last 3 months, gold's been doing very well. IWM has really popped up, has had a much better 3-month period than QQQ, mainly because it didn't drop as much as the Qs, right? When the Qs started to drop in July, the Russell actually rallied until July 16th, and then maintained a similar level all the way to the end of July, whereas even the S&P was lower at the end of July, and the Qs were much lower. And so by the time that we bottomed out on August the 5th, IWM was actually still positive. So that's the main reason it didn't drop as much. It held its value better during the declines, even if the Qs are outpacing it on the rallies up to the upside. You can see commodities and the dollar really struggling over the last 3 months. If you look at just today alone, you can see IWM was the big winner. It was way the big winner at the beginning of the day, almost up 2%. It pulled back, so less than 1%, and you can see the Qs were negative at one point on the day as they ended up finishing right at break even. Bonds ended up being down, so that means yields were up, but just a little bit. Gold was down. Again, it's been an outperformer. If I go back to, let's go back to the pullback that started, remember, on the 3rd. The pullback that started there on the 3rd, you can see that, obviously all the safety trades did very well, and you can see they're still holding up pretty well, even if everything is coming back to break-even levels on the rally. You still have gold and bonds, so bond yields are still really down You can see the yields here. Like it's up a little bit today, but hardly at all. Excuse me, compared to what it's been down for the past little bit. Remember the whole issue with the carry trade, with the yen dropping, that started on July 11th, and that's kind of when volatility really started to increase right there, July 11th. That's when volatility really started to increase in equity markets. So here's July 11th, is right here. So you can see going into that, we were at 4.28%, right where my cursor is. We were below the 200-day, and we were relatively weak, but not too bad. And then since then, obviously, we're way down, and we're even below the August 5th low point, whereas the market has bounced up. Yields have not, and so and you can also see too, if you look at some of these other things since that same time frame, the commodity index as well, from July 11th, right there. So we were actually July 10th, we were kind of sitting on the 200-day moving average, but from the 11th going forward, we've been in pullback mode as we're below the 200-day moving average. And you can also see we are actually flirting with correction mode on commodities, because we're flirting with breaking the 200-week moving average, and that's a big deal. You can see typically don't have bull markets, or commodities typically are really bullish when the economy is expected to grow. Not surprising. It's obviously typically correlated positively with equities. So it's going to be hard for equities to be too strongly bullish if commodities themselves are in their own bear market, and again, a move below the 200-week moving average. In fact, we're so far below and have been below the 200-week for so long that now all these other moving averages have crossed below. Have crossed below the 200-week moving average now. As you can see, we are into the value area of the past 5 years on this. Is it 5 years? 10 years. The value of the past 10 years. Here's the 5-year chart. There. So same thing. We're in the value area and below the point of control of the last 5 years. So that's, there's a lot of resistance up here, $80, and we're flirting with breaking below 70. Nice little rebound in the last little bit. But of course, the big issue is the rates, right? And what rates you're going to do. And just to kind of give you an idea of what rates have to do, this is the yield curve over the past 5 years. You can see the spread between the 10-year and the 2-year is moving higher. But if I were to change this, you can see the spread between the 10-year and the 3-month spread. So this one right here. You can see we are not close to zero. And so you can see, like, when the spread's normal, this is when they started to hike rates. The spread was very positive. 150 basis points, got over 200 basis points there at the beginning of 2022. But then obviously the rate hike started to catch up to the 10-year, and eventually it crossed over here. We went negative in October of 2022. And remember, the stock market loves a negative yield spread. So ever since we went negative, that's when the market bottomed out. We've been very strongly bullish. So the problem is going to be if we rise and get back above zero, and eventually these two lines, the red line and the blue line, or yellow line, which are the 3 and 6 month Treasury yields, they have to get below all these lines. All these lines you can see are typically above it, not below. Are typically above those, not below like they are right now. So this isn't going to be a soft landing. A lot of people compare what we're doing here to like 2019, where again we were not below. Like here's those lines. Here's a yellow line. When we had these cuts, we were very barely negative, but not for very long, right? We got the cuts and we're they moved down, and these yields moved up after the cuts, and we were done. Soft landing. And of course, in 1995. At the end of that rate hike cycle, both those little short-term lines were still below. After all those hikes, they were still below. So that, this is a little bit of a different issue that the Federal Reserve is in. And you can see the spread is more negative than it's been since the late 70s. So there's a lot the Fed has to do in terms of, that's probably the biggest reason. And The other big reason why the Fed is cutting rates is because velocity of money is declining, and that's what people don't really understand. That's the main reason why the Fed cut rates. In fact, it's probably better to show you here. Let me bring up my Twitter profile and I'll show that to you. That'll be a little easier to see. So bear with me 1 second. Everything's going slow for me. Of course, whenever I need it to move, it doesn't. All right, so here's the this is the big reason why the Fed cuts rates, is because the velocity goes negative. It starts to fall from a peak and then ultimately goes negative. And the orange arrows, are where the Fed started cutting rates. And you can see we were either like crossing zero or below zero. Right now, we're not quite there yet. The blue arrow is kind of showing you where the velocity money. The velocity money is the money changing hands, and that's the other thing I pointed out in a Twitter on Twitter here the other day. Is I'm just kind of giving everybody a little preview of the Fed cut meeting. So let's see here. So again, from 2020 to 2023, the Fed added $6 trillion to that's how much they added to the money supply. The average gain for the 10 years before that was around 640 billion. So had they maintained the average, they would have added anyway, right? So if they maintained this average down here, they would have added $2.5 trillion anyway, and that would have been just fine. The problem is they added $6 trillion. So that means there's an excess of $3.5 trillion above the trend line, even including the drawdown. Right? They're one of those 4 years of the drawdown. So even including the drawdown, we added 40%. So when you look at that number now here, 40% we increased the money supply from before 2020. By the end of 2019, we increased it, including the drawdown. We've added it by 40%. And so we still have a lot of money in the system. And again, the point of rate cuts is to get the velocity going up again, right? You want the whole point of rate cuts is to get the velocity of money turning higher, turning higher, turning higher, turning higher, turning higher, right? That's the whole point, right? Eventually, I mean, they can't nip it in the bud. They don't start cutting rates right at the low point of velocity. Velocity will keep, it's got some momentum to it, so it'll typically keep going once you start the cuts. But eventually, you want it to move higher, right? Move higher, move higher. The problem now is if we get velocity money turning higher without it really even going negative, right? Because again, this is the highest level of velocity money where we're starting a cut cycle that we've seen in a while, because it was the highest level again in the rate of change of velocity of money that we've ever had at that peak there, barely eclipsing some of these others. So we're starting it really early, these cuts really early according to this, which again, depending upon how much lower, like some of these, you can see the bear markets. This is a bear market and a bear market and a bear market. You can see it happen here in a bear market and a bear market there too. Eventually, the velocity kept going down to pretty strongly negative levels. That's what happens in bear markets. The velocity money really drops down to very low levels. So they're trying to nip that in the bud before it gets to really low levels here. But if it does turn back up, without really getting below zero, with 40% of an increase in the money supply already there in the system, then you can kind of see, so right there, 40% more in the system, then you can see now why it's easy to get the inflation rate down. If the inflation rate goes up, it's easy to get it back down. That is not the hard part. As we saw in the 70s, every time it peaked, it always came back down. That's not the hard part. The hard part when you get a spike in inflation, after bringing it back down, with all the things you did to get it back down, is to keep it from going back up, right? With all this money that's extra still in the system and velocity money now expected to go back up, because that's the whole point of rate cuts, all that extra money starts exchanging hands more. That's your without a significant increase in real GDP to help offset that. If we don't get a significant increase in real GDP, then that is your definition of inflation: a higher supply, bigger supply of money, and a higher velocity of money. That is, that's a bad combination for inflation. Unless, again, real GDP, so inflation-adjusted GDP, grows at a very high rate, which is what happened in the late 90s. So we were able to offset it in the late 90s. Now the question is, will we be able to have it now, right? Because the Fed only cut 3 times in 1995. The Fed's expected to cut 8 times by next June, according to the futures market and according to the bond market. So we'll see tomorrow with their projections what the Fed's thinking. But that's going to be the ultimate driver of what happens with equities here going forward is what the Fed ends up and what they're projecting themselves to do going into the end of this year and beyond into next year as well. All right, well, that brings us to our trade idea for the day. So let's take a look at Microsoft. That's what I wanted to look at here today. So again, we've been trading the Magnificent Seven stocks for a while here. Here's another one. Nice, good bullish pattern, right? We've got the bear tag. We definitely built on it. Dark green shading and a green line. The intermediate lines up into the, not just in the upper reversal zone, but extreme bullish levels. Very strongly bullish. That's very nice to see on an intermediate line basis. Very nice to see really on any one of those lines for that matter. If you take a look at its weekly chart, it's got a nice weekly reversal pattern here. That's great. Back up above a rising 10-week moving average. PPO starting to rise. Pretty decently strong size candle down there at the bottom. Obviously, you have 3 green arrows on the chart. Oops. If you take a look at the 2-line version of those 3 green arrows, you can see, we're above the 50-day, right? We've crossed out of the value area. We held the 200 point of control for support. MACD is pretty positive. Stochastics is at bullish levels. And now I'm going to show you all these oscillators, which are also going to show bullish breakouts. I mean, that's a bullish breakout pattern above 30, well below 20 on the DMI. This is a bullish breakout pattern up above 60, and we did get above 200 there. That's very bullish. You look at the Ichimoku cloud. You can see we're above the cloud. The 8 and 17 or the 9 and 26 day lines here are moving higher. Rate of change is clearly positive. We haven't even started a weak bullish trend yet. So you can kind of see we're definitely not mature in this move. You can see we are flirting with the upper band and the upper quartile. We're also flirting today with being above the upper Keltner channel. Closed right at the upper Keltner channel on the way down after gapping up. And you can see the green lines as the bands move outside the Keltner channels and they're increasing bullish momentum. So I like the setup here. So what I decided to do was to go out to October expiration and sell that low 30 delta on a call option, buy 1 strike away. So it looks like this. Position size normally like we do for $500 and get about almost a 2-to-1 reward to risk ratio. You can see the trade already went through during the Market Outlook live video that I do every day before the market closed. So there's our trade idea for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody. And buckle up for tomorrow. And we'll see you all then. All right, goodbye, everybody.